Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Hall of Fame fund manager Gervais Williams of Premier Miton, one of the UK's smartest small and micro cap investors. So welcome, Gervais.
Nice to see you again, Paul.
Yeah, well, we seem to have now entered a golden age of healthcare innovation, sort of partly triggered by the pandemic. We've now seen sort of like mRNA vaccines come through. We've got sort of blockbuster COVID diagnostics and testing, and now we've also got a huge backlog of sort of screenings and elective procedures to work through over the next few years. But from an investor perspective, how do you see sort of the opportunities within the sort of healthcare sector?
Well, I think what's been interesting about the last 12 months isn't just that small caps have done very well, or even that main market has outperformed the US stock market in sterling terms, but actually, of course, that the nature of change has been so dramatic that certain companies haven't just succeeded, but actually their market positions have actually substantially improved. And I think that is very much true of the medical companies, some of the small technology companies at the bottom end of the bioscience sector.
Yeah, and how do you actually go about sort of like sifting the winners from the losers? What do you look for? I mean, I look sort of like with life sciences and sort of the pharma is sort of the biggest thing being the technology. Is it leading edge? But how do you sort of select when you sort of like decide on which companies to invest in or not?
I mean, the key driver is what we're looking for is substantial cash returns.
Yeah.
So many of these companies have been investing in many cases for many, many years, over quite a long period. And as they get nearer the finishing post, although the upside is there, the cash payback is coming, often people have got so bored because the share price hasn't gone up for so many years, or they've had a number of issues, and people get a bit bored with the secondary placings, that they actually don't give full fair valuation of the upside. So most particularly, we're looking for companies which are particularly towards the end of that process, quite close to the cash payback, with substantial cash payback coming soon. One of the ways of verifying whether they do actually have something which is very valuable or just something which is quite interesting is to look at the partners. We spend quite a lot of time talking about partners, what kind of verification, what kind of due diligence they've done. To be honest, if we had done as much due diligence as some of their partners, we probably wouldn't be allowed to deal in the company because we'd know too much.
Yeah.
So in that kind of guy, you can piggyback on the back of some of the due diligence on the quality of some of the companies and find out not just where they are now, but how much they've responded once they've seen more of the science, sort of a year or two after they first got involved in business. So those are two factors which we're particularly interested in. And then thirdly, we're just interested as to how that's going to be sold. Ultimately, it is about that cash payback. You know, some companies use third parties, others are going to have to build their own sales forces. Both have their advantages and disadvantages. It's about the speed to market and the ability to take market share and obviously generate very substantial sales.
Yeah, I can imagine actually if you've got a small sort of pharma company and you've got a massive partner, sort of like a huge, great big, sort of big biopharma business who's actually using it. It's a massive endorsement of that technology, isn't it? Of how it's success. And one you've certainly got right is Avacta, because that has just had a huge spotlight over the last 12 months on its technology, and it seems to have, sort of like multiple shots on goal, whether it's the rapid lateral flow testing, the Affimer platform, and likewise the precision sort of chemo warhead technology. But how, given you're the largest shareholder with still a very big stake, sort of 28 million, I think, at the last count, pounds wise, how do you see that business? And obviously, you've been sort of like deciding to position, reposition the portfolio. But I mean, what do you see? How do you see the business's prospects going forward?
Yes, it was an unusual one. I mean, like many other small bioscience companies, it was very, very overlooked, prior to COVID arriving. And in fact, we felt the upside on the business, back in 2019. Was still very substantial in the therapeutic area. It's got the opportunity of delivering some outcomes which will change the ability of many of the mainstream chemotherapies to be applied numerous times with less toxic outcomes. And that's particularly associated with the strength of their partners and the progress that partners have made even in the last couple of years. What has changed, of course, along the way is that they're Affimers and they dominate the Affimers, which are a bit like antibodies, a bit smaller, a bit more resilient, but most particularly they can be used in a wide range of areas and most particularly in lateral flow tests. And although they weren't the first lateral flow test to the market, they like to think that, and we agree with them, that they've got one of the best outcomes in terms of detecting people who are infectious being a high, high accuracy on that, but also getting very few false positives. Specifically, you can't just go around telling everyone that they may be infectious and then find out, 5 days later they're not, because that's just too disruptive. And it's that combination which we think is very exciting. They've now got the sign up with the CE mark, which means that it now can start to be sold. And ultimately, it's a question of just not so much, whether they're going to get customers, but how many can they deliver? Because there's actually a real tension in the supply chains as to the volumes of potential volumes. And what's been interesting about their progress over the last 6 months is that they've signed up a number of partners which are very substantial in terms of volume and lateral flow tests. And assuming that they get the orders, they've then got the ability, in our view, to distribute very substantial numbers. And this could make a very tangible difference, not just to their profits and cash flow in the very short term, but also the whole profile of AFMAs. In the marketplace, with many of the other major science pharmaceutical companies beginning to say, let's take another look at these things. They seem to be doing something a lot better than many of the other technologies we're using. Yeah,
I think the whole, you say that showcasing of the technology because of the pandemic. I mean, you mentioned about the therapeutic side, but the diagnostics now has really sort of like shone a strong light over that whole technology, and it can be used, I think it was in purification as well as sort of like COVID testing and diagnostics. So yeah, I mean their partner base looks terrific. Now another one also, which I'd looked at years ago, and unfortunately I'm guilty of the guilty party, i.e. such that I sort of like, okay, I can't really get my head around it, is Amryt Pharma, which is really just sort of be a buy and build, sort of focused on sort of rare and orphan diseases, but is now sort of proposing to buy a US business, which I think is called Chiasma. And that's it seems like, how do you see that one? Because it's actually quite cheap. In fact, if you believe where the forecast could be.
Absolutely. I mean, certainly the quality of the science is very, which is very impressive, and the quality of their partners is very impressive. And of course, they are quite close to the finishing post in terms of, they've now got a patent to get approved by the FDA in the US, and that's going to be substantial. They've got a priority application if they want to use it. I don't think they need to use it, and that may have value in itself. So this is another company we've been invested in. In fact, we've taken profits on that one, not because actually we're particularly upset by them. We think that there's more upside to come. But there's still actually a large number of other companies which we think are overlooked. Even now, the stock market's risen since 2008. Many stock market indices are going through new highs, and yet many small quoted companies, particularly microcaps, are still at ultra low valuations. And so we've taken some profits on this one and moved on to another company.
Yeah, I mean, I did the numbers, and it's still sort of like less than 3 times sales, and it should be profitable next year, which base for a leading for a pharmaceutical company commercializing is very dirt cheap. And I would say, when it comes to sort of like with orphan diseases and rare diseases, presumably the pricing power on that is tremendous. And if you're a dominant player in a small pond, then presumably that gives you immense strength and it helps the investment case, I would have thought.
Well, you've got to be a touch careful about that. Clearly, if you are the only product which can,
understood.
Make real, therapeutic benefit, then you're in a very strong negotiating position. But ultimately, of course, small areas of medicine only have small numbers of patients, and there, all sorts of health services, not just the UK, but international health services have to balance the needs of the many versus the very extreme costs of helping the few. So from that point of view, actually, I think that there's a real pressure ultimately on corporates, especially in the medical sector, to be careful about pricing. They need to make a commercial return on their investment, but they can't gouge, obviously.
Yeah, okay. Yeah, there was a very famous case, wasn't there, about 5 or 6 years ago, where I think a business got their risk correctly slapped for doing exactly.
Well, I mean, what actually happened in that case was they acquired a business which already had a product, and then because they were the only product, they then increased the price by manyfold just to make more profits, not because they'd done a lot more science or there was a lot more value add.
Yeah. And then just on the sort of the pandemic, we've seen breakthrough vaccines. So that's been a big, massive tick in the box with mRNA. We've seen, hopefully now, we have seen sort of like, super accurate lateral flow tests, as you say, to identify people who are infectious. And what the last bit is a breakthrough therapeutic. So people who obviously go into hospital can then be treated and take the weight and the burden from the health services, as we're seeing already in India. And one again, which is, I keep missing these things, but it's Synairgen, which you've obviously invested and done very well. And they're going through sort of final phase clinical trials out in the States, but they do sort of inhaled interferon beta, which, as I believe, helps patients recover. And again, can you just quickly talk through that one? Because I saw the shares have done very well to about £1 or it's over £1, but I saw FinCap saying that they're worth £5 if they get approved, if they get regulatory approval. So seems to be plenty of runway attached to that one as well.
Yeah, I mean, what's interesting about this one is, in a way, they're slightly using the body's own mechanism to fight off virus, and in some cases, some of that virus is some of that defense mechanism is suppressed by the viruses, and they're just sort of re-emphasizing it. So it's amazing that again, this is a company which has literally been crawling over broken glass for the last 10 years as a quoted company, managed to get enough capital to get to the finishing post. But as you know, July of last year, they got the first results, which showed that their product, when you inhale it, helps you to avoid going to hospital and gives you quicker recovery periods. And most particularly, that's not just applicable clearly to the COVID patients, though that's a very good application. But now we can think that actually the original application, which was very much for asthma patients who might get colds, to actually help them fight off some of the common respiratory viruses for them. So it's got huge application. They've done phase 2 data, which was very exciting. They're now in a phase 3 trial at the moment. They will then, once that concludes, assuming that the data is good, they will then be able to distribute it around the world, and they've got all the rights to this. It isn't, they haven't sold it a long way or all the way to other people. They've absolutely still got the market position. So this is something which isn't just advantageous because it helps people recover from COVID viruses generally. It's actually something which you can use at home.
Yeah,
and you can stop going to hospital, and all the costs of being in a high dependency bed and the cost of bed blocking and all the other things can make a radical difference. Again, it's brilliant to seeing UK science generating such tangible outcomes on a world basis. And
you raise a very good point, because sort of like the pandemic, if nothing else, has sort of like created a sort of a Silicon Valley cluster type of medical research within the UK, given it even big cap with likes of Astra and Oxford University, but all these small caps now, really, they're actually leading edge. And hopefully, do you think they'll be feeding off one another to sort of like, to be able to improve their services? Because obviously, they're people orientated. I mean, is it possible to get a sort of like a mini Silicon Valley effect in the UK? Because it seems highly likely, given the level of science we have.
Yes, I mean, I think there's a bigger effect. I think there's, success breeds success.
Yes.
People to join, and some of the companies which have been in successful companies then set up their own businesses. So there will be a proliferation effect. But I think perhaps even more interestingly is the fact that actually many of the patterns which we've got used to with the US stock market outperforming the UK and all that kind of thing, I think is beginning to change. I think with inflation and more uncertainty about global growth because of all the debt out there, I think we're going to see markets being a little bit more equivocal about funding these things. And the UK is distinguished from the rest of the world, not so much in terms of our economy. Our economy is pretty much similar to many others, but our stock market is nearly unique. We've got a vibrancy of small quoted companies listed with the ability to raise additional capital. And what we saw with many of these cases was when the opportunity arose, things changed with COVID. They weren't just there with their technologies ready to take advantage of it, but they could scale up at that stage and do extra things. And this, Avacta and Synairgen both raised capital. And it's the ability to actually get extra capital at a moment when things suddenly move in their favor, which has been fantastic. So I think going forward, the UK's sort of, stock market, with the ability to back not just science companies, but small science companies, which are often running on relatively shoestrings compared to the cost base of many of the majors, and the upside still being very substantial, is just an extraordinarily exciting opportunity for the future.
Yeah, I totally agree. And also, when we look through the vaccinations, the mass vaccinations, and we see that we're going to be constantly dealing with new variants. I mean, you've got Avacta, who basically can tweak their AFMA platform to be able to identify new variants like the Indian variant. You've got Synairgen, who said this morning that their interferon beta already covers, I think it was the South African and the Kent variant this morning. And then that needs to bring us neatly on to Open Orphan, another one which has done tremendously, because I think it does challenge vaccine and drug testing, but clearly, it has a, it's difficult to get a regulatory approval, I guess. But given the sort of the amount of, or the danger of variants, then it's going to be absolutely swamped with new business, I'm guessing, because you want to be able to tweak the vaccines ahead of plan, and therefore, what's the best way of actually quickly testing it? And it's a challenge vaccine, I guess, isn't it?
Yeah, the key issue about Open Orphan, which is quite interesting, is that they actually have labs which allow people to test the efficacy of their products and to the progress of the virus and such like. This is very sensitive stuff. You're in many cases infecting volunteers deliberately with COVID, and that it's not just the effect of COVID itself, which can give quite adverse risks during the disease itself, even if you're a relatively healthy individual. But most particularly, you can also get long COVID as well. So so you've got to be very, very attentive to the risks you're taking with your volunteers versus the groundbreaking outcomes that can give you in terms of insight about how to treat this the disease going forward. So the UK actually is one of the few areas which is well set up for these kind of clinical trials with patients, healthy patients being used. And to be fair to Open Orphan, not only have they built that ahead of time, and that's obviously been a strong opportunity for them to book up and allow people to progress their own products, but most particularly they've expanded in Role Free and others to actually, so they've got many more beds now which they can use. So again, absolutely, leading edge stuff, albeit that it's well controlled and careful and all those kind of things. And it's just great to see again all of that. Hard work, the long-term spade work which has gone into building this business, often at sort of below the radar, and now they suddenly come when we need it, and we suddenly find that we in the UK are one of the leading countries in the world in addressing some of these issues.
Yeah, and as you say, and not only is it good for the for investors and for the actual businesses, but for the world, isn't it? Because if we are dealing with these sort of like mutants and these variants which come through, as you say, you need the lateral flow test to identify. You then need the genomic sequencing, and the UK I think is doing the only 100% almost genomic sequencing of everything positive. Once you get the genomic sequencing sorted out, which is hopefully at ASAP, you can then sort out you can check it with the Synairgen's interferon beta, and then you can actually test it and tweak the vaccines using Open Orphan. And then you can sell all that information to the vaccine makers. So, it's a perfect fit, isn't it? You just rapidly be able to do it. Just on this, in the healthcare sector, we've got obviously the COVID and the pandemic, but we have built up, and this is around the world, huge backlog of elective procedures, and I think there's 4.7 million patients currently, and that's just in the UK, and that's excluding everybody who needs to be screened. And one business that has really again transformed over the last 12 is Totally, because it helps the NHS, and again that's done really well. How do you see that runway going ahead? Because it's got a huge backlog of the NHS has got a huge backlog, and is looking for sort of secure basically partners to be able to help it get through it.
Yeah, the great advantage of Totally is that they've got a number of services. They help the NHS run the 111 service, among other areas. But the area where the upside could come most substantially is using some of the NHS infrastructure during weekends. For example, a lot of the hospitals don't actually keep or don't use their operating theatres at full bore during the weekends. Now, a lot of the consultants, are off doing other things, but if you offer the consultants extra pay, and if you offer nurses extra pay, you can then put those weekend capacity in operating theatres into production, and that gives you a big catch-up trade. And if they're relatively similar operations one after another, you can get through quite a large number in a weekend and make a real difference. A real difference to the waiting list, but of course that makes a real difference to people's lives.
Yes.
Again. Just terrific to see our companies, our businesses, actually working hand in hand with government to actually achieve outcomes which actually are not just commercially successful, but actually make a difference to people's lives.
Yeah, and millions. And then the last one on the healthcare, which is another breakthrough one I hadn't really seen, is tissue Regenix, which I understand is sort of like a helps to sort of decellularize, helps people regenerate. Really, I think they're, you know, whether it's skin and whether it's parts and stuff. Do you want to quickly talk us through that one? Because again, this is trading on a ridiculously low valuation. If you look at it on a multiple of sales, about sort of 2 times sales, and it's been impacted a bit by the pandemic, but should hopefully, given the elective procedures, have a long runway ahead.
Yeah, so this is quite an interesting company because, again, it helps people regenerate. If you've had an injury or if you need skin covering, new skin and to cover wounds and such like, they can help you by giving a scaffold of which your new skin can grow. And it's just an amazing area for growth. The problem they've had up to now is they haven't necessarily had enough supply of raw materials, and that's held them back. They've also had a relatively tight balance sheet until last year. So from that point of view, I think both those features meant that actually the full value and the full upside was held back. What we've seen with COVID, of course, is not many operating procedures. We're just talking about that. So this is a company where, as we see more operating procedures, as people start to address some of these issues, then you'll actually find that their demand goes up, their supply has already been sorted to some degree. So again, this is a company where we believe sales could grow very substantially. We think it's actually, again, got a really unique market position in the world. And if it comes through, then that will actually not just generate more sales, but of course profits, allow them to reinvest, allow them to fund more staff and more R&D. The kind of the flywheel effect as that spins up could be very substantial.
Yeah, I'd point investors to have a look at all of those healthcare stocks, because the runway ahead and the opportunity is absolutely massive. Now, just moving bases, we'll sort of like look at some of the online winners which have done really well. You've got some lovely stocks in the portfolio, and there's a couple of actually new IPOs, and we'll just kick off with Virgin Wines, which is an amazing brand, because I remember it from a records label and then went into sort of like airlines with Atlantic, and now has got into money and mobile and spaceships, Galactica. And it's also, the brand has been able to stretch into wines. And I understand you participated within the Virgin Wines the IPO, but again, the product looks, the company looks pretty well cheap, and they do D2C sort of like wine delivery, I think.
Yes, obviously it's a competitive area. There's a lot of wines out there. There's a lot of people selling wines. And so in a way, it's quite difficult to make your way and take significant market share in this area. But the reason why we feel more upbeat about Virgin than many others, one is the Virgin brand does actually, many of the services are relatively high-end service levels. But most particularly, the difference between this company and many other wine companies is that they blend their wines to particularly suit the feedback from customers. So over the years, they've got a number of wines where many people really like it. It just absolutely suits them down to the ground. And the advantage of them blending their own wines rather than bought-in blended wines by some of the winemakers is that once they've got the blend, then you don't need to always go back to the same farm. You can blend the same flavors with the same ingredients using other farms. So the net effect is that they actually can be much more competitive. The price point of the wines, despite them being getting very high marks by people who drink them, is that actually they're not that expensive. Yeah. And on top of that, many of their most, the wines which people like the most tend to turn over an awful lot. They don't have all these huge number of brands. They've got relatively shorter list of different marks, but most particularly these are the ones which people like. So they tend to get much more asset turnover. They turn over their stock about 6 times a year, which is probably about twice as much as many of the other wine merchants. So the net effect is they need less cash to fund this stock, and most particularly, they generate plentiful surplus of cash as they keep turning over asset turnover. They keep making the margin on their assets. So from that point of view, it is much more cash generative in our view than many other competing companies. And it's that ability to generate substantial cash and, of course, deliver to their customers' profile with the PLC status. They've been recruiting large numbers of customers, not just last year, but hopefully this year as well. So I think it's that combination of growth in the customer base plus the better financial metrics, which I think is going to hopefully drive the share price on from here.
Yeah, I would say that, you know, some of the skeptical investors out there say they've obviously had a boom time over the last 12 months with getting recruiting customers,
Absolutely.
but how many will go to other providers? And I would point investors just have a look at their website, because it says that the more than 90% of their wines by volume are exclusive. So if you're right, you know, you've basically decided customers have come on because they love their wine. Well, they can't get these blends anywhere else. So,
I mean, some of the marks, like the champagnes and things, obviously they use the mainstream marks. But when you're buying, you know, a Sauvignon Blanc or something, you know, whether it's one particular New Zealand type or a different type of New Zealand, to be honest, it doesn't make so much difference. What you're interested in is the flavour. And they've done some terrific job in terms of aligning their blends to what customers really like.
Yeah, another one which is an IPO, which I hadn't even heard of, is In the Style, which is a sort of like an e-commerce women's wear fashion brand with sort of like influencer, sort of like, you know, collaboration model, etc. Just for sort of aimed at 16 to 35-year-olds. Is this another Boohoo and ASOS in the making? Because it seems to be doing really well. Yeah,
it's interesting, isn't it? So this is a company which it's actually used the influencers really to build its market sales. So influencers, as you know, are people online. They've got big followings. They talk about all sorts of things, and one of the things they talk about is clothes. And what In the Style do is say, well, if you work with us, you can have a big influence on the nature of the clothing and the things which you like and the styles you like, and then you can talk about that with your followers and hopefully generate plenty of sales. And they've done quite well on that. It's not a big company, this, you know, we're talking about a company which is really running at sales about 40 million, so it's a tiny relative to the size of Boohoo, for example. But what's been interesting, and the reason why we invested, is that they've been moving up to influencers who are not just bigger influencers, but actually are probably moving to a more sort of sympathetic aspect with natural fabrics and recycled product and all that kind of thing. And we think this is going to be a good combination, not just the influencers, but actually having product which is more sympathetic to the world. We think is going to become. So I think fashion is moving on to some degree from the fast fashion, sort of throwaway fashion we've got, to actually people particularly now buying things which they want to keep a bit longer. And so from that point of view, their new influencer has just started. Again, it's sold out very quickly. But we think as that starts to become more dominant, they'll be bringing other similar influencers on. The thing could become much, much bigger. We're really impressed by the quality of the management, the ability to deliver, the kind of the very safe way they run the business. It's really very impressive. It's a tiny business, don't get me wrong, tiny versus Boohoo. But obviously, it could double or triple when Boohoo wouldn't even notice.
Yeah, and if you get viral sort of like marketing as well, sort of like going, you haven't got to pay for the sort of like the cost of clicks on the internet. It just comes to you anyway. So
exactly that.
Another one which has done really well on the online is AO World, and I did notice that the CEO and founder came back about 2 years ago, and they went through, because he came back to sort of like steady the ship and right size the boat, and they've actually had and again knocked the ball out of the park last year, as everybody was staying at home and ordering online sort of fridges and bread making machines, and but the shares went up and then they've sort of like flatlined a bit since then.
Yeah, exactly. They've come back a little bit. It's interesting really because again, we think the advantage of AO isn't just that they're there to service people, and unfortunately, a lot of the major retailers have been closed, haven't been able to deliver necessarily. So they've been able to take market share considerably. Really, for most of last year, they were struggling actually to have enough product to put down their channel. But most particularly, the reason why we are so upbeat about this company isn't just that they're hopefully got high service levels, which is important, but also in contrast to something like an Amazon, when they deliver, it's not that you get a third party delivering, you get an AO truck with an AO staff member or two staff members. They come in, and that means that really they can really make quite sure that you get outstanding service, not just on ordering or indeed picking up getting the one you want at the right price, but also it's installed and operating. And it's that feature which we think is particularly distinctive. And at the moment, its market cap is about 1.2 billion market cap as we speak today. This is a company which should be able to do, according to forecast, 1.6 billion turnover. It may do even more. We just don't know. So this is standing at less than 1 times turnover. Let's just remind ourselves, Amazon stands at 2 or 3 times turnover. Yes. Now, of course, it's a bigger company, it's more profitable, it's a later stage of the cycle. But what we're really saying is that even now, we think this company is well positioned to justify the valuation, but it's now moving into cash generation, the ability to reinvest that cash, the ability to continue to expand in Germany, which has come into profit now, it was in loss last year. All of these things are momentums, and yes, the share price has peaked out. That's fine, not a problem. Let's see what they say later in the year.
And the other thing I think is, I mean, I've had a couple of communications with the guy, the CEO and the founder, John Roberts. I don't know about you, but he seems dead passionate about the business. I mean, this is not a money sort of trip for him. He loves the business. He wants to get involved. He wants to increase it. He wants to, enhance the brand and the margins and just do a great service for customers. And when you have that type of ownership of real sort of like personal interest, then that level of detail is going to be sort of like infiltrate the whole company, I'm guessing.
Absolutely. I mean, he's absolutely passionate about customer service.
Yeah.
To deliver passionate, customer service, you have to have a very engaged workforce, and he really cares about his workforce. By way of example, he had a remuneration scheme last year, which he put in place. The share price was only about £1.50 at the time. It doesn't actually pay out at all unless the share price exceeds 5.65, which is a long way up, and only pays out in full if they get to 11 quid. I remind you, the share price is only £2.56 at the moment. So they're not even anywhere near the payout. But what was interesting about that is he said he would take, the senior staff took 20% of that, and his share of that, if he gets to £11, long way up from £2.56, is that he would get 20 million, and he's already committed to give all 20 million to charity. You just think, well, that is ridiculously good leadership.
Fabulous.
Meanwhile, he's given 80% to the rest of the staff. Right?
Yeah.
So the guys who actually deliver the stuff are in the same scheme as he is. Now, so the whole engagement of staff and the ability of engaged staff to deliver outstanding customer service is just sensationally important in our view. And I think that's one of the reasons we're very upbeat about the future.
Yeah, I mean, that's leadership at the front, isn't it? It's sort of like definitely walking the talk. Another one, OnTheMarket. Now, this is quite an interesting one because it's a sort of online property portal. It's ridiculously undervalued when you compare it to the likes of Rightmove. And it's their leadership team is sort of like really sort of like increasing the product footprint rather than just do sort of like online marketing to properties. They're also now heavily moving into the lettings. I think they bought a company called Glanty, which is a prop tech, and they've just added just recently sort of like more technology for endorsing, basically, or of checking. Background credit checking of renters and stuff. How do you see this one position? Because it seems to be filling out its portfolio and is again hugely undervalued.
Yes, I mean, what's interesting about this is clearly Rightmove dominate the market, and there are Zoopla and others out there as well. But this is a company which has always focused heavily on servicing some of their estate agents, some of the smaller estate agents, giving them access to market, and hopefully offering a slightly premium service. Sometimes some of the new houses on their estate agent network go on their site maybe a day before they go on to others, and that means that people come to their website. I think they have got a very strong market position. I think that there's been a huge surge in demand for housing outside of London, partly because people feel that they can, if they're working in the office 1 or 2 days a week, they can then take a longer commute. So there's people moving out of London for that reason. And there's been a real surge in house prices, as you know, because there's a shortage of houses.
Which is incredible, isn't it? I mean, I think it was all the big experts were saying it's going to be minus 7% last year. How far wrong can they be?
So, I mean, so to be fair, the share price has risen very substantially. It's now moving into hopefully into profit in the coming year. So from that point of view, we're upbeat about it. That said, it is now running at about 3 times sales from our point of view, and generally at that kind of valuation, unless they're going to grow absolutely like a Trifid going forward, which they may do, we tend to take profits. We've taken profits in this case.
Yeah.
Not because there's anything wrong. Again, we think that they're very well positioned. They continue to do all the right things. But we think that valuation has got to a level where we found other things which are cheap.
That's quite interesting, actually, because I mean, I don't own the shares, but I'll take the other side of that one. And the reason why is because their historical sales have been hit because they gave a bunch of discounts to their estate agents, and therefore the people who pay will get those discounts will roll over, particularly in a hot market. And then they've got a bunch of guys who don't pay at all. And you could easily see. Well, anyway, we'll wait and see. When we chat in 6 months' time, let's see on the sort of top line, because that'll be.
I mean, I would be just as delighted. I mean, we often sell our holdings. And so people shouldn't be too much into that. We've done very well. Thank you very much for the hard work people have done. but we're always trying to find other things which are still coming through.
Yeah, good. Can you actually just on the I'm losing your sound a bit? Can you just speak a bit closer to the PC?
I am sorry. Yes, I'll try and speak up as well.
That's better. I just lost you a couple of moments there. Okay. Another IPO you had was Supreme, which again has been sort of like I think it does vaping. It's got vaping brand in the UK and also does other sort of products, which again has done very well. I think last time it had sales had done terrifically. What attracted you to that IPO?
What's nice about Supreme is that they built a business really from very little to start with. Particularly distributes a lot to smaller convenience shops, local shops. And most particularly, it started in areas like batteries. It uses it doesn't own the Duracell network, but it actually uses, it does use that brand to sell batteries and other batteries.
Yeah.
They've started off in smaller areas, and they've been very good at customer service, very responsive to customer needs, and that's meant that they've taken market share, quite substantial market share. And once they've got that market share, then they can then put more products down the same channel. And as you say, the area which has been particularly successful for them in the last 18 months has been the vaping market. There's lots of other vaping brands out there, but they fill their own bottles, they have their own quality control. That means, therefore, their cost base is low, and they can therefore sell their vaping products to their customers at a low price. And that means that, therefore, they tend to be one of the dominant suppliers. And I think they're one of the dominant suppliers in the UK now in vaping products going forward.
Yeah.
And that's been a very significant area of growth for them over the last 18 months. And what's been interesting more recently is they've started moving into everyday vitamins. So more people over these last 12 months have not been outside much, and you need to have more vitamin D. So people are taking more vitamin D supplements in some cases. Others who are vegan need to take some vitamin B. So from that point of view, there's more need for people to take different vitamins. And again, very high quality, but very easily accessible vitamins, and that's again allowed them to push through with further growth. Again, this company came to the market on well-established sales, but most particularly because of its history, I don't think its valuation was very demanding. And what was subsequent to it is clearly that as that sales growth comes through, as people have recognised the profitability and the scale for profitability improvement come through, then the valuation of the shares has moved up somewhat.
Yeah, well, it's still only on 14 times, and I haven't spoken to the guy, but is it Sandy Chahal or something? Chahal? That's
right. Yeah, he comes from an Asian background, obviously a UK national, but most particularly, a very, very competent business manager.
Yeah.
And just what a wonderful thing,
He reminds me of John Roberts. He loves it. He's absolutely. Founder, and just really just into the detail. And once you get somebody who is really genuinely interested in delivering a wonderful service, I mean, as an investor, it's one of the sort of like you think, fantastic. I found somebody who's dead keen on on what he's doing for life,
Well, absolutely. I mean, what's interesting is we obviously see very large numbers of presentations, probably do more meetings with companies than most other management teams in the fund management sector. But what's interesting about that is when you look at the presentations, there's often a lot about the market position. There's quite a lot about the financials, basically something about the outlook. But there's very little about staff motivation and staff engagement, almost nothing. When you look at the annual report, again, almost nothing about staff engagement and staff motivation, how many surveys they've done, how has it changed from last year, how does it compare with other companies? And then customer service, again, very little data on that. And those are two areas we really spend a lot of time talking with companies. And in these two cases, as you say, they tick very significant boxes in our view, hence we're justifying our involvement.
Yeah, and it's one of the advantages of going into the small caps, because unfortunately, when you get a really big business, you rarely get that culture of sort of like really taking responsibility. You get too many employees who are just there to turn the wheel, essentially. They'll do a job, they'll get the paycheck, but they don't really sweat the midnight oil on it.
Yeah, so it is interesting because I think people don't spend enough time with the annual reports. The good thing about the annual reports is you can't change them afterwards. And that's why I take them so seriously. It's very nice to look at the website, but if it looks a bit slightly wrong, they change it tomorrow and the website says something different. Whereas the annual report says the same thing. And coming back to that point, I think it's particularly impressive when you do get a large company which has got a very engaged workforce. And actually, interesting enough, I'm currently on a judging body for various annual reports. And I've been looking at, obviously, a great range of annual reports. And one of the ones at the top end of the market cap, which I just thought was stunning, not so much in terms of the engagement, the nature of the annual report and the kind of pictures, which are obviously very nice, but most particularly in terms of the staff engagement, I thought was outstanding, was AstraZeneca. Well, there you are.
Oh, brilliant. Well, that's good. That's music to me, because I'm invested in AstraZeneca. So, yeah, they were on the same page on that.
Staff report, and it's exemplary in my view.
Good, excellent. And then another, just finishing off the consumer plays, Ultimate Products. I mean, they've obviously benefit from home working and from sort of home cooking and cleaning and hygiene products and stuff like that. And they've done really well on their online. But they've all the stores and their distributors are reopening now, so they should do well in that respect as well.
Absolutely. This is a company which obviously imports Far East mainly. It's a product range which is through its own brands, which it built over the years. It's got quite a well-established range of brands. It's got quite a well-established range of customer relationships. What's actually happened, if anything, is that with people coming out of COVID, there's a surge of demand in certain products, and many of these retailers are actually just not prepared for surge in demand. And so they're happy to use things like UPGS and global sourcing, UP global sourcing, so to actually generate these things. And you've seen that actually in terms of the trading. They've traded very successfully over recent months. They've had some very strong trading statements, and you've seen the sales growth continuing to surge forward, which is just an impressive business, given that although they do sell some online, really the bulk of their sales goes through terrestrial retailers. Again, horribly impressive.
Yeah, and also I think because of the people being locked down, and obviously we're going to continue to have a roaring economy, people are going for brands, and they the extra features and the extra benefits associated with a specialist, rather than the distributor's own brand, which is frankly the cheap and nasty sort of stuff. So it's that whole sort of like premiumization and upgrading. Now, moving from the consumer to unbelievably cheap companies in your portfolio, and again, Galliford Try get the gold mark, I think, for the most undervalued stock I have ever seen. A big infrastructure stock with more cash and PPE investments than its current market cap, and therefore the rest of the business is in for 3. But it's got a £3.3 billion order book. What am I missing, Gervais? I mean, it just seems I know it's in contracting, and you've got the history of sort of like Carillion and stuff like that. But have investors just sort of like looking at the sort of like the rear view mirror too much, rather than actually looking at what going forward? Because you're going to be increasing investment in HS2, house building, roads, rail, you name it. The UK is going to be pulling the trigger on investment.
Well, that's right. And HS2 particularly is just an enormous project. So that will just sort of crowd out capacity for others. So there's more capacity for the others to do in other things. I mean, what's interesting about this group is it has had a slightly troubled history. It has had some big contract overruns, some losses. It's had to sell its housing division to improve its balance sheet. But what is interesting, and coming back to the points we were talking about earlier, in our view, the management team are outstanding in motivating the staff. Yes, they delegate lots of responsibility to the staff, but they really highlight those areas where commercial risk is very high, and they steer away from that. So our view that the chances of them getting the scale of write-down they've had on previous contracts is much, much less than it was. On the other hand, as you say, after the housing sale of the housing business, and with their current balance sheet, clearly there is a certain degree of prepayments by some of their customers in some of their contracts. So not all of that cash is truly theirs. But even so, when you look at the balance sheet, it's incredibly strong. Very, very substantial cash balances. You've got a company there which is at a market cap of about 140 million market cap versus a sales of 1.2 billion or something like that, according to market forecasts. So you've got a really big business here in a tiny market cap with a very strong balance sheet, and most particularly the confidence about the future, which is represented by the ability to pay dividends and dividend growth going forward. So absolutely, in our view, this company is reflecting the past rather than the future. That's why we've supported one of the largest shareholders involved. And as that comes through, as you say, the government's going to be investing quite hard. Some of the businesses are also investing. You've seen an awful lot of new build in terms of distribution centres and other things going on around the country. So there's a real shortage of building materials at the moment. There is some inflation coming through in those areas. And so clearly they've got to manage that. But most particularly, we think the risk-reward ratio is extraordinarily attractive, as you said.
Yeah, and if you've got the CEO, I think is it Bill Hockling at the top, who's absolutely sort of like into the detail, then it should recover very nicely. Another one which is really sort of like a couple of them actually which are really good value. It is Xpediator, which is freight forwarding, and now just on that one, I mean they do logistics centered in the UK and Eastern Europe, but from my sort of simple understanding, the whole logistics area has really sort of got four tailwinds: e-commerce, outsourcing, reshoring now from Asia, and also warehouse automation. So again, I think it's trading on, what's it trading on? 12 times PE. So for a business that has got margin expansion and those tailwinds, how do you see that? I mean, the shares have done well, but they're still very cheap.
They have come quite a nice long way now, from where they were a year ago. And people are having a real kind of anxiety about Brexit before we went through it. And although there is some inefficiencies which have been introduced by Brexit, not just in Calais, but also moving into Northern Ireland, there is some extra costs associated with that. But ultimately, we've moved beyond that. Indeed, as you say, domestic growth is going up. People need more product. Many of the supply chains are quite lowly stocked at the moment. We've got really an inventory shortage at the moment. So you need to pull more product forward. And in many cases, the costs of transport have gone up. And of course, a company like Xpediator has benefited from the fact that actually there's a shortage of capacity in certain areas. So the combination of both come through very strongly. I mean, what's interesting again about this company is, yes, it's now at an 85 million market cap as we speak today. But most particularly, here's a company which is doing perhaps 200 or 230 million of sales. So again, a small change in margin on the sales makes a big difference to the P&L, makes a big difference to share price.
Yeah, well, I look forward to that. And then the final one, just on the undervalued, is you. Now, this whole sector, again, a bit like the contracting, went through sort of like difficulties with investors, and it's a multi-utility, I think, for sort of water, electricity, and gas, etc., for SMEs and other corporates in the UK. But it seems to be, obviously, it's well placed for reopening trade as corporates go back into offices and restart all their businesses.
Yeah, I mean, it's interesting because the original chief exec, well, the current chief exec, Bobby, he started in a different business actually, and then he noticed that one of the supplies of things like gas and such like were very poorly organised, and so he sold his previous business and moved into the supply of gas, but also electricity and water to corporates. He's a supplier. This isn't a distributor. He buys the gas. He hires the pipes and he distributed it to his customers. So in contrast to a broker, this is not really a broker.
Oh, okay. I didn't appreciate that.
It's an important differentiation from that. But what's interesting is that they actually grew quite fast. They've gone on quite well, but unfortunately they found that they weren't good enough at when they took on a new customer, recognizing that some customers didn't use as much gas as they said they were going to use, and not making much provisions. And the share price absolutely, having been £10, got down below £1. And so, here's a company again with strong balance sheet. It's got net cash on the balance sheet.
Yeah,
it's not a big market cap, 43 million as we speak today. But most particularly, it's taking market share. It's got real momentum under the business. Coming back to companies which have energized and engaged staff. I think he's a brilliant leader, and I think his staff are delivering very high levels of customer service. They're taking market share from the others going forward. You've got the ability to grow the revenue very substantially over the next couple of years, and as that comes through, the company moves from loss into profit. Again, we've seen the share price beginning to move on that, but that's a lovely combination to come through. All that spade work which has gone past, the ability to turn the business around after it had its financial setback, but most particularly now on the up, in our view, and hopefully likely to continue.
Yeah, and then just finally, we've got sort of two exciting green environmental sort of slots. One is, I don't know how you pronounce it, is it EQtec, and the other one's Synairgen Atlantis. But you've got EQtec is the sort of gasification technology business, waste to energy. And I think Synairgen Atlantis had a bit of a choppy period, actually, but again, is in renewables. How have you viewed those? Because they've obviously come down quite a bit, and then they've got sort of like, massive runways ahead.
Absolutely. I mean, EQtec is an extraordinary company because, it's taking basically rubbish of one kind or another, and they're able to convert it into energy. And they can take a wide range of different products. It's not so much the problem with taking some of these things, converting into energy. You need a very kind of similar source in most cases, whereas their technology can take a wider range of products on the way in, which is brilliant. What was amazing about this company is, when we were looking at investing, we spoke to some of their customers in the US or Greece, for example, as a sort of verification process before we invested, because we just couldn't believe that a tiny company like this, an engineering company, could have so much of a technical lead compared to some of the others in the marketplace. And that is what's happened. I mean, they've started taking major orders around the world. They've started investing in some of their own sites and returning them around, which used some of their technology where they can get it to be more efficient going forward. It's a very fast-moving group. Again, the share price has risen and peaked out a bit like AO Group, but in our view, it still continues to have the long-term upside, which we think is very exciting for it. So well placed for the future. I know its share price has risen considerably over the last 12 months, but we still think at the market cap it is. Small sales, it's got to deliver an awful lot of sales to justify its market cap. But in our view, the risk-reward ratio is attractive. Interesting when you compare that with Cymac, which we have had in the portfolios for many years, where actually, although the new sort of impellers, underwater impellers, have been collecting energy and they've got a global lead in certain areas, and just today they've talked about Japanese impellers is operating as a commercial outcome. Ultimately, it's taken a long time to get to the finishing post. We still think that actually there's still quite a way to go. The market cap has been very high. As you know, the market cap touched over 200 million recently in terms of euros. So, it reports in euros. So from that point of view, we have taken most of our profits in that one. It's still very exciting. It's still leading world technology. It's likely to be a success going forward. We take most of our profits.
Yeah, no, I think the new CEO in there, Graham Reed's got his hands full at the time, because I think they've got a big project, haven't they, in Uskmouth in South Wales, where they're trying to convert a power station into some sort of renewable.
Yes, I think that's taken longer to get the planning permission they were looking for. Obviously, that's been called in by the regulators, and we'll see exactly what they think. But most particularly, it is again a company which could be a world leader in this industry, and hopefully it will be.
Yeah, well, thanks very much, Gervais, for your time. And again, I would point to investors, if you're looking for sort of like breakthrough sciences, just run your slide rule over Gervais's portfolio, because it's full of them. But again, what the sort of the key things to be, concentrate on the science, look at endorsements or your partners on the technologies. And if you've got a really passionate and engaged management team, it goes a long way. I think is probably three brilliant themes that investors should take forward. So thanks very much, Gervais. Appreciate your time.
Thank you very much, Paul. It's a good pleasure.